that AI is the biggest investment opportunity of our lifetime. The only difference is that I used to highlight buy on strength, and right now I'm highlighting buy on weakness. So what we want to do is wait for that sell off and really buy on that weakness right now. We won't be overlooking big tech. We think big tech will get bigger. And of course, that has to do with the costs associated with AI and the data that's required to train models. A lot of this is closed source with APIs. And then secondly is the fact that big tech just has a lot of cash and can remain very defensible even in a period of higher interest rates. So it's kind of a win-win there. Not only will big tech probably be the winner in AI, but they have a lot of cash, which doesn't hurt. So this is a rough timing on AI. Certainly NVIDIA's GPUs are key. They're critical. We do believe the NVIDIA is to AI what Apple was to mobile. However, there are other important stocks that came from mobile, Google, Android, clearly Facebook. I would have loved to have bought Twitter at IPO. I mean, there's definitely a few that were also very important. And then, of course, leadership rotates. So I'm going to show you that objectively, that NVIDIA will come up against tough comps. It's very, very hard for a company that performs well in that triple digit level, which is 100% or higher growth, to come up against those comps the next year and put up that kind of growth again. That is the nature of growth. It's just a headwind that is very hard to overcome. And so there will be rotations within leadership. It's one of tech's favorite things to do to us investors, which is what led last year won't lead next year, won't lead the following year. And so you can see that in the numbers. So that's another reason not to just buy 100% allocation to NVIDIA and call it good. NVIDIA will sit out a couple years, or will sit out 1 year here, 1 year there, because of leadership rotating. We are looking for GPU competitors. We really like memory because that's where GPUs are going to start to compete most in terms of the way that they stack up against each other. Memory is one area that will play out. So that's already happening. I'd love to get memory cheap, a memory play, a memory stock very cheap based on consumer when underneath the hood, AI is bubbling. We do want to buy beaten up consumer AI plays. So again, once we get that sell off, if we can get that sell off that Knox is talking about, we want to position for 2025 and beyond. So that will include some consumer AI plays. We put out an excellent analysis on Apple that the team worked on, and there will be other bottom buys, basically is what I would call that. Look for an ASICs surprise. At some point, there's going to be an ASICs surprise, which would be big tech going for custom silicon, which very likely to happen. Speculative today, but makes a lot of sense on the chessboard. So we want to keep an eye out for an ASIC surprise, which would be our Marvell, a 1% to 2% placeholder minimum. And then as time moves on, that's when we would probably buy AI inference at the edge, big data and analytics. Although we'll probably have that placeholder on AI inference sooner rather than later. The reason why we think big data and analytics could be slower is because the primary buyer for AI is big tech. They have their own proprietary big data and analytics platforms that they hope you buy, that you adopt instead of best of breed. They're typically competing with the best of breed cloud companies. So what the best of breed data and analytics companies really need is more AI participation from SMBs and developers. Big tech is not typically their best customer or customer at all, because again, they have their own proprietary platforms. So we want to wait for that, but you can see where AI inference at the edge would kind of move very closely to big data and analytics. But then at the end on the right, automotive is massive. So that we definitely want to be locked and loaded for. You're seeing some of that in Air right now, AEHR, Air, because they're just participating so early in that supply chain. And as that supply chain becomes more mature and automotive is seeing some of those, obviously they're a silicon carbide company or related company, but as you start to see AI move into automotive, that's going to be a massive opportunity for IO Fund members as well. And the reason why we drop off in 2030 is because hopefully we're all retired by then. That's certainly my goal. I think that that is actually quite realistic if we nail more AI plays, and AI is the one trend that has the potential to get us there. So 2030 should be pretty exciting if we play our cards right. I would go so far to say that if we get a massive sell-off in 2024, that what we buy is what we retire with in 2030. So that's the moment, and we're preparing for it.